Hi traders, I'm Bezos and welcome back to the channel. Today we will be discussing an important topic for all traders, whether you're a pro or a beginner. These are strategies that you must know and take with you as you trade. We will be reviewing pullbacks. A pullback is simply a short-term movement against the dominant trend. Think of it as a breather the market takes before continuing in the same direction. But spotting a true pullback requires context. Here's what you should look for. It happens within a trending market, not during consolidation. It typically respects previous structure points or key zones like supply and demand. It doesn't disrupt the overall trend, meaning the higher highs or lower lows are still intact. Let's say you're in an uptrend and price retraces back to a prior order block. If that move doesn't violate the last higher low and volume is cooling off, it's likely a valid pullback. You can even use a buy limit at the base of that block. However, if that pullback is too aggressive, breaks market structure, or surges with high volume, it might be a reversal disguised as a pullback. And that's where traps lie. Now let's talk about what candles can tell us. A pullback leaves behind clues in the wicks and bodies of the candles. In an uptrend, you want to see a break of a previous candle's low, suggesting liquidity is being tapped. But that break must be short-lived, not part of a bigger bearish shift. For example, if a red candle in a pullback dips below the last green candle's low, and the next few candles hold above that, you're looking at potential reversal fuel. Remember, it's not about the color of the candle, it's about what the candle is doing. If it sweeps liquidity and closes strong in the direction of the trend, that's your signal. With each candle going past the highest points of the previous candle, it is important that the lowest point of the candle remains higher than or equal to the lowest point of the previous candles. This same concept applies in a bearish downtrend scenario. Here is a series of bullish candles. Here we can see that the price never broke the lowest point of the preceding candle, and thus is not a pullback. On our second example, we see a temporary halt in the trend. However, again, the bearish candle does not break below the previous candle's low, so this is not a valid pullback. Contrary to these here, we can see that the bearish candle has an equal high with the previous bullish candle, and the subsequent candle breaks below the low of the bearish candle. This would constitute a valid pullback. There are three major pullback forms you'll see. Knowing which one you're in can drastically change how you approach entries. Aggressive, corrective, sweeping. Starting with aggressive pullbacks, these are sharp, sudden moves often with large candles. The market quickly retraces, but without confirmation, these can burn you. They're fast and impulsive. Don't just jump in. Wait for structure to slow down or shift. Let's imagine we have a series of candles like this one. As you can see, the price has broken below the lowest point of this candle, which was the latest low before the temporary pause and reversal. So, we have a valid pullback here. Price, after completing its corrective movement, reversed and pushed to the upside with great inefficiency. So here we have a valid break of structure, as the price has formed a valid pullback. Now, since the price has created a bullish break of structure, we can identify this demand zone attributed to it, which we believe has a high potential to reverse the price when it reaches that point. Next, we are waiting for the price to move back down again and tap into our identified demand zone. In the aggressive pullback type, the price generates a rapid and drastic movement with strong candles that quickly retrace toward our identified demand or supply zone. In this scenario, we wouldn't consider entering the market by opening any position, even with the emergence of confirmation patterns like the change of character or flip patterns in the lower time frame. The rationale behind this is that if the price rapidly and drastically moves with strong candles into a supply or demand zone, without subsiding its momentum, there is a high probability that the price will not react to that zone. Traders need to closely monitor price behavior in such cases and avoid entering the market in situations like this. Corrective pullbacks are cleaner. Price moves gradually with smaller candles forming a temporary structure. You can often plan better entries here using limit orders or confirmations like a change of character or break of structure on a lower time frame. As we mentioned earlier, in this example, we have a pullback as the lowest point of this candle has broken to the downside. Subsequently, we have a valid break of structure, and we have a valid order block, which we believe has a high potential to reverse the price when it reaches that zone. In the corrective pullback model, as we mentioned earlier, price forms several internal structures with multiple smaller candles until it reaches our identified point of interest. Despite the aggressive pullback, we consider entering into the market when price reaches our identified demand or supply zone. For doing that, we can use entry models like aggressive or conservative entry models. For example, in this case, we can place a buy limit order at the highest point of our identified order block and wait for the price to activate it. Or we can implement a more conservative manner by waiting for price to tap into our identified zone and then zoom into a lower time frame to search for any sign of change of character or reversal patterns to confirm a market structure shift. After detecting the confirmation of market structure shift on the entry time frame, we can set our entry position on the highest point of the newly recognized order block. In this case, a demand zone on the lower time frame, which is created by the change of characters wave, with a stop loss set a few pips above the lowest point of the zone. And for the take profit, we set it at the external liquidity of the higher time frame. Next, we have sweeping pullbacks. Create liquidity just before tapping into your zone. Think equal highs or lows, double tops or bottoms, or trend lines. The market builds a trap, sweeps it, and then reverses. These setups offer powerful confluence when entering trades. For example, here we can see that the price retraced back down, formed an equal low, and also created great liquidity below the double bottom, suggesting the presence of pending orders and stop losses waiting to be triggered and swept by the market, which is located near our identified demand zone. By focusing on zones with liquidity sweep patterns, we can increase the probability of trading setups that align with market dynamics and reduce the risk of falling into false signals or traps. The presence of the liquidity pool above our identified demand zone provides additional confirmation for a potential price reversal from our point of interest. Now that we have the desired confluence, our next step is to patiently wait for the price to sweep the liquidity below the equal lows. Now we have our desired confluence, and now we can consider entering into the market by going long from our point of interest. For doing that, we can place our buy limit order at our demand zone. If we want to optimize our entry point and have a better reward-to-risk ratio with tighter stop loss, we need to zoom into a lower time frame and wait for the price to tap into the demand zone and show a change of character or any market structure shift signal. After the formation of the newly generated demand zone on the lower time frame, we can consider placing a trade. Once you've identified the type of pullback, your entry should match the behavior. For aggressive pullbacks, be cautious. Often, no entry is better than a forced one. For corrective pullbacks, use buy-sell limits at order blocks. Or wait for a lower time frame structure shift to confirm momentum. With sweeping setups, look for liquidity pools being taken out, then a flip in structure on the entry time frame. In all cases, define your stop loss just beyond the invalidation point and place your target near external liquidity, swing highs or lows, to keep risk-reward in check. And there you go. You now have a structured way to not only recognize valid pullbacks, but also act on them with clarity. Whether it's an aggressive retrace, a slow correction, or a liquidity sweep, your job as a trader is to observe, confirm, and then engage. I have a free Telegram group chat that I will link in the description, where I keep you updated on hidden strategies that are used in industry, as well as offer you AI bots to help you with your trades so that you do not have to remember all of these concepts. Let me know in the comments which pullback type gives you the most trouble, and don't forget to subscribe so you never miss a trading deep dive. See you in the next one, traders.